So you're intrigued by offshore banking, and who wouldn't be? The idea of tucking your money away in some exotic far-flung locale has a certain allure. However, as the kids say online these days, you have questions. At this point in the conversation, we'll usually hear something like, "Is this all above board, or am I diving into a murky underworld of financial skullduggery?" Well, my friend, quite naturally that depends on your personal outlook. Done properly, offshore banking is as legitimate as having an account down the street. Done improperly, it's the playground of sociopaths who could make Bond villains look like Harry Potter. However, for everyday people like you and me, the most important thing is to not be scared away from offshore banking as a concept, for it is a crucial aspect of financial literacy in the 21st century. In today's video, we'll explain it all, the good, the bad, and the luxury of offshore banking, step by step, and with a historical lens, so you get the full picture. Sounds good? All right, let's begin with the very fundamentals, for the journey of 1,000 miles begins with a single step. Our breakdown begins in the late 19th century, as financial markets matured and international trade expanded, and the concept of banking began to take on new dimensions. Traditionally, banking meant simply the business of holding money for customers, providing loans, credit, and payment services, and offering various investment opportunities. Therefore, in some ways, before the emergence of offshore banking, traditional banking was pretty straightforward, especially for the average person. They thought of it simply as a secure place where they could store their money, get a loan if they needed one, or invest in basic opportunities like savings accounts or bonds. You could walk into a local bank branch, talk to the staff, and conduct your business mainly within the boundaries of your home country. However, as nations and economies of scale interacted more closely, a specialized form of banking emerged, our lovely friend offshore banking that we're discussing today. In this model, all the typical activities of a bank are conducted in a foreign jurisdiction, adding layers of shrewd complexity and hidden opportunity. In simple terms, bankers, financiers, and even countries realized that they could attract even more money by offering specialized services in foreign locations. For example, if a bank in Switzerland offered better privacy laws or tax benefits than your home country, you might decide to put your money there instead. It became a competitive edge, a way to lure in clients who were looking for more than just the basics, or perhaps murkier ways to stack their coin away from the prying eyes of governmental regulation. As we transitioned into the early 20th century, offshore banking crystallized into a distinctive model. As we've said, unlike conventional domestic banking, the first iron law of offshore banking is that it must occur in a jurisdiction other than the customer's home country. Thus, it can offer a suite of benefits not typically available or even legal in domestic settings, such as tax advantages, increased privacy, and enhanced asset protection. Naturally, the allure of these benefits made offshore banking an attractive option for individuals and corporations looking for a less public and heavily scrutinized place to park their money. Then, the 1920s and 30s saw the burgeoning of the first offshore financial centers, as geopolitical and economic conditions shifted in favor of these specialized banking havens. Switzerland, known for its neutrality and robust financial regulations, became the first popular choice. Then Luxembourg, with its focus on commercial secrecy and strong banking laws, as well as its unique position as technically being part of the EU's open market, was another. The Channel Islands, located between England and France, also joined the ranks of early offshore centers, offering legal and regulatory frameworks conducive to offshore financial activities. At this point, you might be wondering if your average everyday citizen was aware of these developments. In other words, was the average Joe or Jane able to take advantage of this growing offshore market to save on their taxes, hide their cash in a secure location, and so on? Well, to be honest, this was a period when the general public was not particularly hip to these developments. Offshore banking was mainly a subject discussed in the boardrooms of large corporations and among the wealthiest of individuals. Of course, governments were aware, but they were also grappling with the complexities and benefits these financial arrangements offered to their own economies in a rapidly industrializing 20th century. And, to be clear, offshore banking means banking anywhere in the world that is not within your home country. In other words, this phenomenon is, and was, not limited to Western or developed nations. Thus, as the 20th century progressed, offshore banking evolved from a fledgling concept for the ultra-rich and ultra-connected into a complex financial ecosystem, populated by a variety of jurisdictions, not just in the West, but including the Caribbean, Asia, and even the Middle East, as power player countries began to establish themselves as part of this international network. And yet, even as it carved out its prominent role, questions loomed. Scandals, leaks, and increasing scrutiny from governments pointed to another chapter in the story of offshore banking, with twists and turns that no one could fully anticipate. As the clock ticked into the 1960s, offshore banking was indeed no longer just the domain of wealthy individuals and multinational corporations. The role of the state began to emerge as a topic of interest and scrutiny. In this era, governments began to take an interest because of the growing impact of offshore banking on global finance, as well as the potential for political and diplomatic maneuvering. States saw these offshore accounts as tools that could be discreetly utilized for certain sensitive transactions, away from the watchful gaze of the public and other nations. Without a doubt, the offshore platforms offered an intriguing mix of secrecy and financial advantage that governments found hard to completely ignore. And although they might not like to admit it, while governments themselves generally did not engage in offshore banking in the way private entities did, they were sticking their hands into the offshore pie as well. For certain specialized transactions, or to manage resources away from the public eye, state entities like the CIA during World War II and the Cold War did indeed open and operate offshore accounts. These accounts allowed them to perform activities that might be diplomatically or politically sensitive, and by 1970, the landscape of offshore banking hubs had taken shape, providing a clearer picture of which jurisdictions were the most significant players. Hot on Europe's heels were newer entrants like the Cayman Islands, where fewer regulations and a more relaxed tax environment attracted a flurry of offshore activity. Singapore also emerged as a key player, offering a blend of robust legal protections and strategic location that appealed to a diverse clientele. These jurisdictions were more than just repositories of wealth. They had become intricate cogs in the machinery of global finance, each with its unique blend of services, legal frameworks, and regulatory nuances. The year 1975 saw the growing prominence of institutions that had become synonymous with offshore banking. Names like UBS and Credit Suisse were not just popular, they were pillars of the offshore financial community. Thus, Swiss banks such as these had by then mastered the art of attracting foreign capital while providing a diverse range of services from investment opportunities to asset protection. HSBC, with its origins in the British colony of Hong Kong and a growing global footprint, also joined the ranks of these elite institutions. Therefore, this period of the 1960s and 70s was one where the lines between private enterprise and government blurred somewhat in the realm of offshore banking. States themselves began spreading fingerprints in various offshore transactions, while the offshore hubs themselves had emerged as the go-to headquarters of the secretive ultra-rich. This complex interplay between private and state interest against the backdrop of evolving international laws and norms brought offshore banking into a new suspicious light. Thus, as the decade came to a close, unanswered questions began to linger. What undisclosed alliances and covert transactions remained hidden, waiting for the perfect moment to surface and shake the foundations of this complex financial empire? Around the start of the 1980s, the relationship between wealth and offshore banking entered a new, more intricate phase. By this time, engaging in some form of offshore banking had become almost a rite of passage for the well-heeled. The motivations were manifold. Asset protection, tax benefits, and financial privacy stood at the forefront. Wealthy individuals saw the merit in diversifying their assets across jurisdictions, sheltering them from the unpredictable swings of local politics or economies. Indeed, their financial landscapes were often as international as their lifestyles, and offshore banking fit snugly into this global panorama. To put this into perspective, let's say you're a well-heeled denizen of the international set in the year 1985, ready to offshore your millions. Your first stop is usually a meeting with financial advisors or specialized offshore consultants. These professionals won't just open doors for you. They'll provide you bespoke roadmaps to navigate the complex terrain of global finance. Your negotiations with your newfound team of advisors generally will begin with discussions about financial goals, risk tolerance, and the need for asset protection. This dialogue will help with your strategy, whether it's setting up a simple offshore savings account or a complex network of international trusts and companies. After all your dollar's ducks are in a row, you'll wait a few years, knowing your money is safe in the world's top offshore havens, until the year 1990, when your team comes with an even better proposition. Let's not just hide your money, let's have your money make you even more money. You see, by the top of the 90s, the value proposition of offshore banking had indeed crystallized into something more than just a protective measure. It was increasingly seen as a vehicle for wealth creation, and advisors became the linchpins in this transformation. Their role was not merely consultative, but deeply involved in the mechanics of amplifying wealth. They assisted their clients in optimizing tax liabilities, diversifying assets to minimize risks, and sniffing out lucrative global investment opportunities. These services went beyond traditional banking. They were more like a blend of financial alchemy and global strategy, tailored to enrich the portfolios of the wealthy. Fast forward to 1995, and people couldn't help but notice that governments often seemed to turn a blind eye to the proliferation of offshore accounts. The reasons for this apparent indifference were as layered as the offshore accounts themselves. Navigating the spider web of international law was no small feat, and prosecuting offshore financial activities could be a quagmire. Additionally, the infusion of foreign capital into their financial systems was generally seen as beneficial by the jurisdictions that hosted these offshore accounts. However, a more subtle reason lay in the influence wielded by powerful individuals who made extensive use of these murky offshore services. Their clout by then often extended into the corridors of political power, further complicating any governmental efforts to clamp down on the offshore world. Yet, even while its practices became normalized, rumors started to swirl of a forthcoming international agreement that could change the face of offshore banking forever. As the 20th century drew to a close, it became increasingly clear that the offshore world was on the brink of a transformation. Something monumental lurked just over the horizon, ready to pull back the curtain and reveal a game-changing truth. The turn of the millennium signaled another change in the offshore banking landscape. Previously considered the preserve of the rich, the year 2000 saw the barriers to entry slowly eroding, allowing middle-income individuals to ponder their options. However, while offshore accounts had become more accessible, they were not necessarily a wise choice for everyone. For those without substantial assets, the allure of offshore benefits might not outweigh the costs. Transaction fees, legal charges, and maintenance costs could quickly add up, and without a sizable asset base, the advantages of tax breaks or asset protection could be negligible. Thus, for the average individual, the decision to go offshore was often fraught with financial caveats. By the mid-2010s, conversations around the future of offshore banking started to take center stage. Regulatory landscapes were shifting, spurred by a growing demand for transparency in international finance. Governments, financial institutions, and international bodies were increasingly focused on legitimizing the offshore industry, as new compliance measures started to clip the wings of schemes aimed at lowering tax burdens. So as we stand today, we are witnessing a transformation in offshore banking, a metamorphosis driven by necessity, regulation, and changing public perception. The once elite financial tool is becoming democratized, yet also facing existential questions around its purpose and ethics. For the middle-income individual, the evolving landscape offers cautionary notes. Offshore banking is becoming accessible, but it demands a heightened sense of responsibility and awareness. For the industry at large, the future is an unfolding chapter, one being rewritten to harmonize with the government-mandated chords of financial transparency. And now, we'd like to see you in the comments. Do you support the existence of offshore banking and think it's a citizen's duty to lower their tax burden as much as possible? Or do you think it's all a sneaky way for the rich to avoid helping those with less money? We think this will be a lively discussion, and we look forward to engaging with you. Furthermore, if you're hungry to learn more about how wealthy families manage their money, why not click the video on screen to hear another deep dive from us on the topic? We'll see you there, or in the community below. Thanks again for joining us, and cheers until next time.